So today I thought I'll discuss with you a topic of Cbse class 12 syllabus, financial market. Financial market. So before going into this topic, what is meant by a market? So if you look at the word market, we can see there are two concepts related with this. One is the traditional market, what we see, which is always having a geographical boundary, a vegetable market, a fish market, etc. And the modern concept of market is entirely different. It is just the willingness of a person to buy and a willingness of a person to sell. So take the example of Amazon. So take the example of Flipkart. What do you see over there? If you are ready to buy something, there is somebody who is ready to sell it for you. So there is no geographical boundary. We have never seen the shopkeeper who have sold us a shoe when we buy a shoe through the Amazon. So that is the modern concept of a market. So my discussion is not about a market. My discussion is about what is a financial market. So if you want to know what is a financial market, you should know one concept in the society. The place where we live, the society where we live, we have two categories of people. We have two categories of people. Number one, we call them as the savers, or the unit which is having surplus amount. They are the individual householders, like me and you. We are individual householders. We are savers. We earn money, we get salary, and we spend our salary, and from that we keep a certain amount as savings. What do we do with the savings? We deposit our money in bank. So we are called the surplus unit. And there's another category of people in the market. They are known as the deficit unit, who want to do business but they don't have money in their hand. Who want to do business but they don't have money in their hand. So what is a market over here? The surplus and the deficit is connected. So there is an intermediary. There is an intermediary who will connect the deficit people and who will connect the surplus people. That is known as a financial market. So you should know that in this financial market, there are three parties. One is the surplus and the other one is the deficit, or the one is the savers and the other one is the one who use that money. They are called as the borrowers. So between these two people, there is a connecting link. We call them intermediaries. So who all are these intermediaries? It can be a bank, a saving bank, a commercial bank is an intermediary. A stock market is an intermediary. So for our learning purpose, financial market is going to be classified into two. We call them as money market and capital market. Before explaining what is a money market and what is a capital market, I just want to say the various requirement of a business. A business requires money. Money is called as the lifeblood of a business. Do you know why money is called as the lifeblood of business? Because whenever we use this proverb, lifeblood, because the life is in the blood. Similarly, in a business, life is in money. Business require money for various purpose. So for various, you should identify the purpose and you should raise the fund which is required in the business from the corresponding sources. For a short-term purpose, if you raise money from a long-term source, that's a dangerous decision. Similarly, for a long-term source, long-term requirement, if you raise the fund from a short-term source, that is also a bad decision. So you should know what are the various requirements. You need money to run the business daily, which means you need money to purchase raw materials, you need money to pay the salaries, you need to pay the money for the daily running expenses. Similarly, you need money to buy the fixed asset. What are the fixed asset? The asset which is used in the business to earn revenue. That is known as fixed asset. Examples: land and building, plant and machinery, furniture and fittings, etc. So you need money for running the business. We call it working capital. And you need money for purchasing the fixed asset. We call it fixed capital. So money market is a market. Usually people use it to raise their working capital. And capital market is a market which is used for the long-term sources of fund. So here comes the difference between what is a money market and what is a capital market. From the money market, or in money market, we have various sources or various instrument. We call it instrument. So there are various instruments in the money market which is used for raising the short-term fund. When I use the word short-term fund, please understand it is for a period less than 1 year. A business requires short-term fund for making the short-term obligations. So there are various short-term requirement: payment of wages, payment of salaries, payment to the creditors, payment of short-term borrowings. So you need to make all these payments. So you need sources of fund. So the short-term sources are the short-term requirements are raised from the money market. Similarly, the long-term requirements are raised from the capital market. So we have to look in detail what is a money market and what is a capital market. So those students who are preparing for the Cbse class 12 examination, please understand, for the Cbse there are certain key words what you need to explain or what you need to write down when you write your board examination. So please note down what are the various important terms when you're watching it. So let us come back to money market. So as I told you, money market is a market where the short-term sources of fund are raised. So what are the various, we call it instruments. See, in commercial language, instrument means not the instrument what you see, it's various documents. So in the money market there are various instruments. First one, the most important one, is known as call money. What is a call money? So don't get confused with the call money what you are learning in your joint stock company accounts, I mean shares. That call money and this call money is different. So if you want to learn what is a call money, you should listen to me carefully. So what is a call money? See, according to the Reserve Bank of India, every commercial bank need to maintain a certain amount of money with them. Just for an example, let us take a bank this is just an example I'm saying. Let us take an example. A bank need to maintain 100 crore rupee as a minimum amount. Just I'm saying as an example, 100 crore rupee as a minimum amount. Now, for example, there are various circumstances where this minimum amount will go down. For example, today morning when the bank opened, it is having that minimum ratio. This is our CRR, cash reserve ratio. So they are maintaining their CRR as 100 crore. Immediately one customer came and he is having a deposit with the bank and he is withdrawing 5 crore rupees. So what happens? Banker cannot say that if I give you 5 crore, then my CRR will go down, so you go and come back tomorrow. Banker can never say this. Banker will immediately honor him. Banker will give him 5 crore rupees. But when banker gives him 5 crore rupees, what happens to the banker's CRR? From 100 crore, when 5 crore he is giving, it comes down to 95 crore. So the CRR comes down. This is a problem for the bank. What will the bank do? Bank immediately make an arrangements with the nearest branch. What will the bank do? Bank will call it's over the phone. The manager will call the nearest branch and say that please transfer 5 crore rupees to my account. So when the nearest branch transfer 5 crore rupees to this bank's account, what happened? From 95 crore, it was 100. From 100, 5 crore is given. A deposit came and withdrew. Only 95 crore. Now the other bank is transferring 5 crore to this bank account. So automatically it will reach the 100 crore CRR. This money is called call money, and they will not keep this money for a long time. So morning 10 o'clock somebody came and withdrew, your CRR went down. 10:30 you made a phone call, the other bank transferred 5 crore rupees. Now after half an hour, after 1 hour, somebody came and deposit money, so you got more than 100 crore in your account. So what will you do? Immediately you will transfer it back, you will repay it. This CRR is borrowed from bank for hours, maybe 1 hour, 2 hour, 5 hour, or 1 day, 2 day. They won't take it for more than 7 days. Within that time they will repay that money. This temporary financial accommodation, or this temporary financial adjustment, or this temporary borrowings are known as call money. So this is one financial instrument. Another financial instrument is known as Treasury Bill. This is also an instrument in the money market. So what is a treasury bill? Whenever the central government requires money, central government will inform Reserve Bank of India to raise the fund. So how will they do that? So Reserve Bank of India will issue this document. That document is known as treasury bill. So treasury bill is open, everybody can buy it. So Reserve Bank of India issued treasury bill on behalf of central government. Only when the central government requires this, they will do that. No other authority can issue this document. Okay. Now how the treasury bill is transacted? You buy it at a discount and you sell it at the face value. For example, a treasury bill is always sold at a face value of 25,000. Remember, the face value of a treasury bill or denomination of treasury bill is 25,000, not less than that. So if you want to buy a treasury bill, minimum 25,000 you can invest, and this is fully secured amount because the guarantor for a treasury bill is central government, and you needn't worry about the security. Since it is highly secured, the rate of return is very less. You should understand that there's a basic principle in business: when the risk is more, return is more. At the same time, the chances of loss is also more. Same logic is applicable over here. When you invest in treasury bill, the risk is very negligible, and because of that reason, return is also negligible. So how does this happen now? Suppose the face value of a treasury bill is 25,000. When you buy that or when you subscribe that, you might pay very little less from 25,000. Let us say 24,500. So 500 less. That's called the discount. And on the maturity date, the date will be mentioned in that. On the maturity date, when you repay, when you surrender it, you will get 25,000. So the difference amount becomes your profit. You're paying 24,500, and on the maturity date, when you surrender it, you're getting 25,000. What is the difference? Your difference is 500 is going to be a profit. So this is called a treasury bill. Remember, this is done by Reserve Bank of India on behalf of central bank for raising the fund for the government. Is known as certificate of deposit. Again, this is a confusing situation. There is something called fixed deposit. Fixed deposit is different from a certificate of deposit. This can be certificate of CDs. It's known as CDs. CDs can be issued by commercial banks. When a commercial bank want to raise fund, if a commercial bank is also a participant in the financial market, so if a commercial bank want to raise fund, what will the commercial bank do? Commercial bank will issue documents. One such document is known as certificate of deposit. So people can buy the certificate of deposit and give money to the commercial bank. Commercial bank will utilize that money for lending purposes. So that is known as certificate of deposit. Remember, certificate of deposit is different from fixed deposit. Certificate of deposit is different from fixed deposit. The next important document which is used in the money market is commercial bills. Commercial bills are of two types: trade bill and accommodation bill. Commercial bills are of two types: trade bill and accommodation bill. If my memory is correct, a commerce student will be learning about bill of exchange in your accountancy. Same item is this. So when a seller sells goods on credit, a bill is prepared, which is coming under the Negotiable Instrument Act. So a bill is prepared. This bill can be discounted with the bank. This bill can be discounted with the bank. So a trade bill can be discounted with the bank, and that becomes a source of finance for a business organization. And trade bill is usually drawn for 3 months, 90 days plus the days of grace, that you all know that what is days of grace. So that is also a financial instrument in the money market. Trade bill and accommodation bill. Accommodation bill is a bill which is drawn on an imaginary transaction. So usually banks are little reluctant to discount an accommodation bill, but at the same time banks will discount the trade bill based on the creditworthiness of the businessman. If you are a creditworthy businessman, bank will not have any problem in discounting a trade bill. But in case of, if there is a default, if you don't have a regular banking habit, and in case if you are a defaulter, bank may not discount the bill. Otherwise, these commercial bills are also one of the most important instrument in the money market for raising the funds. We are going to see capital market. So in the beginning I have told you a money market is a place where short-term sources of fund is raised, and a capital market is a place where long-term sources of fund is raised. Long-term sources of fund. Now when I use the word long-term sources of fund, you should know what is that. That's called a fixed capital. What is the requirement of fixed capital for buying the fixed asset? Now what is a fixed asset? The asset which is used to raise the revenue in the business, that is known as a fixed asset. Okay, now when you look at the capital market, as I told you, capital market is a market from where the fixed or long-term sources of fund is being raised. Now what are the various now if you look into the capital market, it is divided into two: primary market and secondary market. Primary market and secondary market. So that's again a little confusing thing. So first of all, financial market is divided into two: money market and capital market. We saw what is money market. Now we are looking into capital market. Capital market is divided into two as primary market and secondary market. Now we are going to see what is a primary market. Primary market is a market for the issue of, or for the first issue. So basic difference between a primary market and secondary market, we can say like this: primary market is a market where the new shares are issued, and a secondary market is a market for second hand shares. Secondary market is a market for second hand shares. Now for example, if I want to make this concept very clear, take the case of a car. You buy a new car from a new car showroom, and if you want to buy a second hand car, you go to used car showroom. Remember, in used car showroom they never sell new car, and in the new car showroom they never sell used car. So that is the difference between a primary market and a secondary market. So a primary market is a market for the initial offering. So we used to say that initial public offer. Initial public offer. Initial public offer means the first time issue of a shares of a company. If a business organization is going to, or if a business sole proprietorship is going to be converted into a company, a partnership is going to convert it into a company, first time when they issue the shares, that share they issue in a primary market. We'll see in detail what is happening over there. And once it is being issued in the market, whoever buy this share, if they want to further sell it, that happens in the secondary market. That is why secondary market is a market of used shares or second hand shares, and that is your stock exchange. So secondary market is your stock exchange. Now why it is called stock exchange, we'll discuss later. Let us come back to primary market. So primary market is the market for the fresh issue. Primary market is the market for the initial public offering. Now what is this initial public offering? So let us discuss about what is primary market. So I told you a primary market is a market where the initial public offering. So you used to see the advertisement in the newspapers or reports in the newspaper, such and such companies going public, or IPOs. This is some terms what you read in a newspaper. So what is the meaning of this? Now I'll just say one example of organization, Cafe Coffee Day, one of the leading organization in India, having numerous outlets in various parts of India and abroad, other countries. So Cafe Coffee Day was started as a partnership, and it have grown. And I believe in 2015 they decided to go public. So what did they do? If an organization want to convert its status from partnership to a company, there are a lot of formalities they need to comply with. According to 2013's Indian Companies Act, you need to follow various formalities, numerous steps, and once you follow numerous steps, you reach into a stage where you are in a position to raise the fund from the capital market. So we are discussing about that. So when Cafe Coffee Day decided to go public, what did they do first? They started giving advertisement in the newspaper saying that Cafe Coffee Day is going to sell the shares. Those who are interested in buying the shares, you cannot go to any stock exchange to get the shares. It was available with the agents of Cafe Coffee Day. So what did Cafe Coffee Day did is they identified few lead players in the market. They identified few bankers, they identified few other underwriters and other lead players in the market, and they made an agreement with them. They did not go to the stock market. You will not get it in the stock market when they're selling it first. So they gave advertisement in the newspaper saying that on such and such a day, Cafe Coffee Day is selling its shares to the public, and you have to go to such bank. For example, I think in Bangalore market, they tied up with the SBI. For example, I'm just saying example. So on that particular day, you can go to State Bank of India. Bankers do this. You can go to State Bank of India, or you can go to another agencies where they have made the agreement with. So go to them and you can buy the shares from them. So that is known as a primary. Now suppose, imagine for an example, Mr. X went to an agent or to the agency where the shares was available, and he bought 1000 shares from an agent. After buying the shares, after few months, if he want to sell the share, if he go back to the same person from where he bought it, he cannot sell it over there. He cannot do that. So the first time where the shares are bought and sold is known as a primary market. It can be with various types of agents. There are so many agents who does that. Most of the bankers does that, and there are other corporate houses which does that. So you have to make an agreement with them for the selling of the first shares. So this is known as a primary market where your first shares are sold. Now for example, Mr. X, as I said, Mr. X bought shares of Cafe Coffee Day. After 6 months, if Mr. X want to sell the shares, where will he go? Here comes the option of the capital market. Sorry, option of the secondary market. He will go to the secondary market. And what is this platform? Where is this platform? Stock exchange. So he will go to the stock exchange. When he go to the stock exchange, he can see there are people who are ready to buy the Cafe Coffee Day shares, so he can sell the shares over there. So that is called the secondary market. And from where it is sold first, it's called the primary market. Now in the primary market, there are various ways of selling the shares. First one is by offer through prospectus. You issue prospectus. Now what is a prospectus? A prospectus is a simple document through which you look into that organization. It's a window for you to look into that organization. So what all informations will be there in the prospectus? What is the present status of the company? Who all are going to be the first directors of the company? Who all are going to be the other necessary important professionals of that organization? What are the future activities of the organization? So this is the way by which you come to know about that company. Otherwise you will not be ready to invest your hard-earned money. If you are ready to invest your hard-earned money, you want to know what type of organization it is. Otherwise you won't invest. So prospectus is a window through which you look at that organization, and based on that you make your investment. So this offer is to the public. So they give the prospectus are issued through newspapers, means advertisements will be there in the newspapers or various other means. So whoever see that, opportunities for all, whoever see that prospectus, they can approach the corresponding agent to buy the shares. This is one method. The second one is private placement. So what is a private placement? In private placement, actually what happens is the company, the business organization which is selling the shares first time, IPOs, what they will do is they will not offer to the entire public. They will select few rich people. It can be organizations, it can be individuals. They will select few individuals or firms and approach them and sell the shares only to that limited number of people. Such steps or such way of selling the shares are known as private placement. So here what is happening? You will not see the advertisement, you will not see the prospectus. So that's a different arrangement. They find out, they select a few people, they approach them, they talk to them, make arrangements and sell only to that few people. That is known as private placement. Next, another method of selling the share is known as offer for sale. So what is offer for sale? In this case, what happened? Again, between the company and the shareholder, there is an intermediary. The whole shares are purchased by an intermediary from the company, and he in turn sells the shares to the public. So he'll be having his own ways and means of selling it. So that is known as offer for sale. So we have discussed the first one, issue through prospectus, private placements, offer for sale. One more method is there called a right issue. So this is another important thing. So this is also one way of issuing the shares, but you should understand a little bit over here to understand what is a right issue. So I'm giving certain numerical numbers for you. Imagine a company is going public. So in the formation stage, when you are trying to form a company, you are preparing a document called Memorandum of Association. You'll be learning it in your business studies class. In class 11, there's a topic called Memorandum of Association. In the Memorandum of Association, there is a symbol clause called, not a symbol clause, one of the most important clause called capital clause. In the capital clause, you have to clearly specify what is the maximum number of shares you are going to issue, and that maximum number of shares is called the authorized capital. Now, for example, you have written over there, you are going to sell, the authorized capital is 10 lakh shares. Authorized capital is 10 lakh shares. These numbers please keep in mind. So the authorized capital of the company is 10 lakh shares, but right now when you're going public, you are selling only 6 lakh shares. Out of 10 lakh, you are issuing only 6 lakh shares. So in the initial public offer, out of 10 lakh, you are issuing only 6 lakh shares. So you issued 6 lakh shares, you did the business is going well, and you are planning for expanding. And if you're planning for expanding, you need further money. Now see, out of your 10 lakh shares, you have issued only 6 lakh shares. Remaining, how much is there? Remaining 4 lakh is there. That remaining 4 lakh, after few years, you're going to sell again. That is also an IPO. But second time, when you are selling the remaining shares, what will you do? That's a question. Now see one example, continuation of that. Few years back, your company sold 6 lakh shares, and few years back, when your company sold 6 lakh shares, Mr. A purchased 1 lakh, Mr. B purchased another 1 lakh. So A, B, C, D, E, F, 6 people purchased 1 lakh each shares. So your 6 lakh shares are purchased by A, B, C, D, E, F. Now after few years, when you are selling the remaining 4 lakh shares, what will you do first now? You will ask Mr. A, B, C, D, E and F, you will ask them, we are selling the remaining shares, are you interested in buying? If they are interested, you will sell this share to them first. If they don't want, then you will sell to others. But if they say that they want it, you have to sell these shares to them. When you sell these shares to them, you will be selling at a little lower price. You won't be selling at the price price at which you are planning to sell it to an outsider, because they are the one who helped you before. So the right of the previous shareholders to buy the remaining share, that's called right issues. So when a company is issuing the remaining lot of shares, that shares will be offered to the existing shareholders. If existing shareholders are buying it, we call it right issue. So offering of the shares, remaining shares to the existing shareholder is known as right issue. In case if they don't want, then that shares will be sold to the outsiders. So these are the ways by which the shares are sold in the primary market. Anyone who buy these shares from the primary market, or all those people who have bought the shares from the primary market, whether it initial public, whether it is offer for sale or offer through prospectus or private placement or right issue, if you want to further trade the shares, you have to go to the secondary market. That is why it's called the secondary shares or second hand shares. So that will happen in the stock exchange. And then you have to see how that happens over there. That is again something different. Thank you.